Hi there, and welcome to our channel. In this video, we're going to talk about something that affects many of us: debt. But not all debts are created equal. There's good debt and bad debt, and understanding the difference between the two is important for your financial well-being. Let's start with bad debt. Bad debt is any debt that doesn't increase your net worth or generate income. This includes credit card debt, personal loans, and payday loans. These types of debt often come with high interest rates and fees, making it harder to pay them off. For example, let's say you put a $1,000 purchase on your credit card with an interest rate of 20%. If you only pay the minimum payment each month, it could take years to pay off the balance and you'll end up paying much more in interest than the original purchase price. On the other hand, good debt is any debt that helps you increase your net worth or generates income. This includes student loans, business loans, and mortgages. These types of debt can help you achieve your financial goals, like buying a home or starting a business. For example, taking out a mortgage to buy a house can be considered good debt. While you'll have to make monthly payments, owning a home can increase your net worth over time and provide stability and security. Now that we've covered the basics of good and bad debt, let's talk about how to manage your debt effectively. 1. Prioritize paying off high-interest debt first. If you have multiple debts, focus on paying off the ones with the highest interest rates first. This will help you save money in the long run. Create a budget. A budget can help you track your spending and make sure you're not spending more than you can afford. It can also help you allocate money toward debt repayment. We'll leave a link in the description on how to create a budget. 3. Consider consolidation. Consolidating your debt into one loan with a lower interest rate can make it easier to manage and pay off. Avoid taking on new debt. Try to avoid taking on new debt while you're still paying off existing debt. This will help you stay on track and avoid getting into further financial trouble. Let's throw more light on debt consolidation, as it seems to be the uneasy one here. Debt consolidation is the process of combining multiple debts into one single debt with a lower interest rate. This means that instead of making multiple payments each month to different lenders, you only have to make one payment to your debt consolidation loan provider. Let's say you have 3 different credit cards with balances of $5,000, $7,000, and $10,000, all with high interest rates ranging from 18% to 25%. That means you're paying a lot of money just on interest every month. Now, let's say you apply for a debt consolidation loan with a lower interest rate of 10%. You're approved for a $22,000 loan, which is enough to pay off all 3 of your credit cards in full. By consolidating your debt into one loan with a lower interest rate, you can save a significant amount of money on interest charges every month. In addition, you'll only have to make one monthly payment instead of 3, which can make it easier to manage and stay on top of your debt. It's important to note that not everyone will qualify for a debt consolidation loan, and it's not always the best option for everyone. It's important to carefully consider all your options and speak with a financial advisor before making any decisions about consolidating your debt. In conclusion, understanding the difference between good and bad debt is crucial for your financial well-being. By managing your debt effectively and making smart financial decisions, you can work towards a more secure financial future. Don't forget to like this video to help the YouTube algorithm, and leave us a comment with any questions or feedback. And if you haven't already, be sure to subscribe to our channel for more financial education and resources.